Welcome to the Lifetime Real Estate Advisors podcast. Today is March 8th, 2024. I'm the CPA mortgage guy, Dan Mullen, and Brady, my co-host, Brady Mullen with American Liberty Mortgage. We're here today to talk about something that, we did the math on this and it blew our minds. We're talking about, so many people in this market today are worried about sacrificing their 2%, their 3% interest rate in order to move. That's what's locked in a lot of people into their homes, right? Financially speaking. But we found a pretty interesting solution that a lot of people want to do anyway. Growing your wealth by owning an investment property while upgrading your home to the one you've been eyeing, but you have decided not to because you don't want to ditch your 3% interest rate.
Yeah, so
What do
this
you think,
came
Brady?
to be this came to be because a friend of mine asked me, "Hey, could you help me quantify what would happen if we kept our home? We want to move, and if we keep our home and use the equity." So they needed the equity in their home to buy the next home, but his thought was, "Well, what if I pulled that out with a HELOC and added more debt to that property for the down payment, or if I sold it and took the equity with me?" So there's two ways you can access the equity, right? And see, he asked if I could help him quantify what would happen financially one way or the other. And after talking it through with him, I think he and I both had the instinct that it would be better to keep the home because you're also keeping that he had a 2.75% mortgage on it. You're also keeping that, which is a valuable thing. That's not probably coming back in our lifetimes. That's a rare gem. And if you have one of those, if you can keep it, that's great. And so he and I both suspected that it was probably better to keep that than to sell it. But we wanted to run the math. And part of it was because he wanted to talk it over with his spouse and wanted real actual figures rather than I feel like it's the right thing to do, which is smart when it comes to finance. Because in so many cases, what feels right and what is right isn't always the same thing. So it's important to calculate those things. So I spent a good weekend digging around in Excel and trying to answer that question out of curiosity and trying to help my friend. And the more I got into that, the more I thought, man, there's probably tons of people in this situation. They're in a home that isn't their dream home. They could afford a home that they want to move into, and there's nothing they could afford it, and it's what they want, but they don't want to get rid of their very, very low mortgage on their current home.
Yeah, and I think it's I just want to interject and say, you spent a weekend building an Excel spreadsheet. You are my kind of nerd, my friend. I've done that too. And that's kind of our
Well,
thing, you know?
and luckily we already had a lot of this stuff built out. So I took the investment pro forma spreadsheet that we have and I made a copy of it and then started toying around because it needed new variables and new things to consider. But a lot of the work was already done, but it is kind of fun. So I'll dig in, but first, what I want to do is kind of just rather than talking about it with language, I'll show some images as to what we're talking about for anybody that might want to see that. Let's see. Let's go here. I'm going to share the screen real quick. So essentially, what we've got here is imagine you're in a home that's worth $650, and you've got a $400,000 loan on it, and let's say that $400,000 is at 2.75%. And if you're hesitant to get rid of that, there's good reason for that. Your instincts are correct in that regard. That's a valuable thing. So that means you have $250,000 of equity. The way most people think about buying this new house that they want is they take the equity out of the home by selling it. And of course, there's going to be some commissions when you sell the property, or even maybe some concessions, depending on the market that you're in, or maybe even some expenses that you'd have to pay because of inspection items, right? The buyers want this improved or that fixed before they close on the house. So,
Repairs.
yeah, so 6% is a pretty conservative loss, and it's 6% of this number, by the way, not 6% of this number. So if you sell the house, you're going to walk away with something less than your actual equity in the house because there's some cost to that transaction, which is expected. So that means you get to take $211,000 down to purchase this new house, meaning you're going to need a mortgage of $739 and some change. So I'm glossing over some nuances in things like closing costs and such, because those are going to vary depending on the market that you're in. But in principle, what you've done is you've taken your equity out of this house, subtract some for concessions and commissions and inspection items and whatnot. You walk away with 211 that you're able to put down on this new home that's worth 950, which is the house that you want for you and your family. So that's what you have at the end. You have the new home. You've gotten rid of the old one. Pretty straightforward. Well, his question was, I'm really hesitant to do that. And what's holding most people back? It's that number there. That's a precious thing.
2.75 interest rate. Not
Yeah.
everybody might be watching, so let's
Yeah. So that
yeah, 2.7.
2.75% interest rate is what causes people to justifiably hesitate to make that move because it's such a precious thing and you'll never replace that, especially not in today's market, but I doubt that will ever come back in our lifetimes. So his idea was, okay, I'm in this situation. I've got a home. I've got this awesome mortgage on it. I've got some equity there. What if instead of accessing that through a sale, what if I access that through either a second mortgage or a HELOC? Now, with most HELOCs, you have to keep 10% equity. Actually, it's 10.01 if you want to be real technical, but you
Right.
got to keep about 10% equity in the home. So you can get a HELOC up to about 90%, 89.99. So instead of selling it and using that, he's taking cash out through the HELOC. Now you'll notice that's a little less than 211,000. You don't get as much that way. But if you use that to get that property, here's what you have instead of the first scenario. You have two properties now. You have the property that you wanted, and you have the property that you lived in now, that you're living in now, the one you moved from as an investment. So that's what you have
And
instead of this. Go ahead.
and you still have that 2.75 mortgage rate on your now investment property. So you're keeping that huge asset.
Yeah, the financial benefit that was providing before, it's still providing you, only it's on an investment property now instead of your primary. So the advantage to the scenario on the left is your mortgage on that new home is $26,000 smaller because you brought $26,000 more to the table to get that property. That's the upside. The upside here is you have more equity because you didn't give any away in commissions or concessions or inspection items. You still kept the 2.75% mortgage, and now you have an investment property. So this is pretty basic. We haven't run much calculations yet. This is just showing after closing, these are the two paths that you could go down. You have this one on the left where you got a little larger equity position, a little lower mortgage. You've got this one on the right where you have more equity. You have that 2.75% mortgage on your investment, and you have that property. So the next question is, what does that look like a year from now, 5 years from now, 10 years from now, which is where the calculations come in. That's what this is. I'm going to zoom in here. These variables here are the ones that we need to know in order to make the calculation. So all the variables are in the colored cells here, these dark blue cells. So your current property value is 650. Your taxes, your insurance, because that's a part of your expenses on that property, because this is going to become a rental. So we need to know what your expenses are. Your first loan is currently $400,000, meaning you have $250,000 of equity. You want to keep 10% equity, or you're required to. Now, if somebody wanted to do a HELOC and only go up to 85% equity, then we'd put 15 in here. So it's not, you don't have to do 10. That's just the example that we're using, which means you're going to keep $65,000 in equity. Your first loan is at 2.75. And in this example, I'm assuming that you refinanced last 2.5 years ago. So you've got 27.5 years left on this current mortgage. That makes your principal and interest payment plus the tax and insurance, which was a variable up above, your PITI payment is $2,156 on this first mortgage. The second loan amount, which is going to be the difference between what your current mortgage is and the value of the property minus the 10% equity you need to keep. So the second loan is going to be $185,000. Here's an example interest rate on the second loan. I'm showing an amortized payment of 30 years. Now, I know a lot of HELOCs don't do it that way. They'll do like interest only for 10 years and then amortize over 20 or some combination like that. I'm just showing a simple 30-year amortization just for payments. Because if you have an interest only option and you make 30-year payments, you'll chip away at the principal a little faster because you're adding some principal in. So this is a conservative way to do it. And if there's a cost to getting that HELOC, we can put that in here. Some banks and credit unions, they won't charge for it. They'll pay the cost to get the loan in place. Some will, some won't. But if you've got a bank where you really like that HELOC, but it's going to cost you $350 or something, that's what we put in that cell. I'm going to push that back to 0 just for today because that's the example we're using, and that's not uncommon, by the way. Right. This is that 6% cost to sell. So if there's some upgrades that need to be made or some concessions that, depending on the market you're in, we might raise that to 7 or 8 or 9. But I'm assuming the property is ready to sell, and we're just going to have to pay commissions to the real estate agents to do that, and it's going to be around 6%. Again, we could even go lower than that. So if you have an agent that says, hey, if you sell and you're going to go buy something else, I'll give you a little bit of a discount because we're doing 2 transactions, then this might even be less than 6, but this is a common number, so I'm going to leave that there. So that means the cost to sell is $39,000. The net proceeds from the sale is your equity minus the 39, that's $211. And your net proceeds with a HELOC is $185, meaning you're sacrificing $26,000 of cash by keeping the home rather than selling it. You're sacrificing $26,000 more dollars that you could put down on that new home. So that's the number that I consider your initial investment in this real estate, because that's the amount you're sacrificing in order to keep it.
And I want to add there too, that's a short-term sacrifice, and it's, I don't know, it's just a cash sacrifice is all, because it still is retained as wealth if you know, keep your old one and buy a new property as, you know, as an investment and such. So I mean, we call it a sacrifice. It's only, you know, just a cash sacrifice in the short term, right?
Yeah, and so that it's kind of like that. So that's a good way to put it, but it also means that by making this sacrifice, you keep $39,000 of equity. Remember that slide before that it shows one of the advantages of keeping the current property is you keep $39,000 more equity because you didn't pay commissions to sell it. So either way, like this is what you don't take as cash when you sell it because you use the HELOC instead. It does keep some money in wealth, but this is the cash sacrifice that you've made to keep that property. Here are the terms. Whoop, sorry. There are the terms for the rental property. Here's what we're expecting in rent. We're always showing some vacancy. I never show 100% occupancy. If there's an HOA, we've got a room for that. If there's any utilities that the landlord would pay, obviously there are some utilities to pay, but unless it's the landlord's expense, then this is going to be zero. Let's see. There's a budget for maintenance and expense. This is a place to add in additional monthly costs for keeping it in ways. This is just a catch-all bucket. So if there's some expense that doesn't fit into these other categories, we can put that in here, and we can even assign a time value. So if somebody has to pay an extra $200 for the next 6 months or something, we'd put 200 in there and 6 here to show that expense for the next 6 months. So that wasn't the case in this example. And this is for property management. We'll talk about that later. This is just a yes or no. This guy wants to manage the property himself. And I know that property management is more complicated than yes or no. But the variables on how property management is charged is in an advanced variables sheet. This is just determining whether those variables are engaged or not for the costs. So that's something that you and I, of course, acknowledge. If somebody wants professional management, then we would turn this to yes, but we'd go to this sheet to make sure that that those costs are being calculated. So total debt payments between the first and the second on this and the tax and insurance. So this is the combined principal and interest on both loans plus the tax and insurance. So your expenses on this property are
Real quick. You mean both loans, meaning your new mortgage for your new home or your old mortgage with your 2.75 plus your HELOC?
good question. So this is just pertaining to the home that you're keeping. So this is your 2.75% first mortgage and your 9% second mortgage in this example. So your expenses, your regular monthly expenses on this property are $3,600, and you're only renting it for $3,500. So that in and of itself sometimes kind of shocks people, and they'll look at negative cash flow on an investment property and think, well, this can't be making money because it's negative cash flow. But of course, if you have real estate investing experience, you'll know that cash flow and your total return are related, but they're not the same thing. So in this example, there's a negative cash flow situation of $144. We'll talk about that in a second. But the assumptions for appreciation I'm using here are 4.5%. I'm showing 3.5% inflation on things like insurance and maintenance and such. I'm showing rent increase of 4%. This is a variable where we can put in tax rates to estimate some tax savings. I'm going to set this at 0 just to see how this performs before we get any tax benefits. And this comparison rate shows what if we'd invested that $26,000 at 10%? How does that compare to what we're about to do? So let's go back out and look at the top graph. So there's a graph of your income, your net income. So you're starting out at negative 144 per month, and that increases over time because of rent increases.
We're talking about cash flow.
Yeah,
right?
So this will cash flow soon. It just won't cash flow right away in this example. Now, this graph is something a little different. This is showing the overall value of the investment. So when you invest in real estate, there's 2 categories where you have value. You have the cash that you put in your pocket, and you have the equity. And the equity is built through appreciation and debt pay down, of course. So here we've got the dark blue is the equity. The white is the cash. So you'll notice the cash is negative for a little bit for the first handful of years. Now, I want to be careful to explain this because this is a little bit confusing, but the reason this is an accumulated number. So if we're accumulating negative cash flow, it's going to have to be positive for a while, which is when this starts to curve up before we actually have net positive cash flow. And the difference between this graph and the one below it is this one only, the one below it, only captures your net monthly income in a month that it's occupied and in a month where you don't have an outlier expense like a water heater or a roof or something. The reason I have this graph excluding vacancy and excluding maintenance is because people need to know what they're going to cash flow on a normal month. So that's what this is for. This isn't designed to capture all of the cash moving back and forth because it doesn't include vacancy and maintenance expenses. However, this graph does include maintenance and vacancy in the cash flow. So you'll see the cash flow is negative for a couple of years when you include those elements, but it starts to get positive, which is why this starts to shrink. And eventually it's positive enough that it wipes out all the negative expenses from before. And then you've got a net positive cash after, it looks like about year 10 is when that starts to happen.
Well, the thing that strikes me when we look at this graph here is the vast, vast, vast majority of your wealth gain is in appreciation. And that's because it's leveraged out so well. That dark blue totally dwarfs that white, which is the dark blue being the equity and the white being the cash. Like, it is so dwarfed by that dark blue.
Yeah, and this is especially true in a scenario like this, because effectively what we've done here is you have turned a property into an investment property with 10% leverage and you're almost cash flowing. That's a really big deal. Could you imagine? So people want to cash flow with 20% down and they get kind of like religious about it. And I'm not going to say anything for or against that. That just depends on the investor and where they're investing and whether or not that makes sense for them. But if you could invest in an investment property with 10% down and get pretty close to cash flow, you're using leverage to the biggest extent that's possible in real estate in an iterable way.
Yeah,
So
it's a beautiful thing, and that because it's so leveraged out, that's where the real power of investing in real estate is. I mean, a lot of people get caught up. It's cash flow, cash flow, cash flow, and of course, near the end of your investing career, if you want to call it that, when you start to retire, you do want to focus on cash flow. You want to shuffle some assets around, pay some debt downs to maximize that cash flow if you want to keep it in real estate. But early on in your investing career, building that engine, which is done by leverage, putting as much leverage as you can safely do, is really where that power comes from. So where you can eventually convert that into cash flow. That's hard to do if you don't have a lot of equity. You have to put a lot of money down if you want something to cash flow, or you have to have it for a long time. So this is ideal for someone getting started in their investing career, investing in real estate.
yeah, that's a perfect example of or a good reminder of why we call loans in real estate leverage. It's exactly what it is. So
Yes.
this is, oh, one more thing we'll point out here is, remember that 10% variable that we had at the bottom that was the comparison rate? This
Yeah.
shows what would happen if we'd invested $26,000 at 10%. That's this yellow line. And the reason they don't start in the same place is because you have a lot more. If you sell the property that you're living in to go buy the new one, you're giving up $39,000 of equity. You start with more equity by keeping the property because you're not paying those commissions and concessions. So this is immediately has the real estate investment immediately has an advantage right out of the gate. But if you'd invested this cash instead in something that was earning 10%, that's this number. And it looks almost flat compared to what we have to do here. The scale on the left just has to be big enough to capture all these numbers. That makes this 10% rate of return look pretty flat. So as an example, if I'd invested $26,000 in something and it earned 10% for the next 20 years, that number would be $175,000 20 years later. Now that's pretty good. If you're investing in the stock market and you put 26,000 in and you have 175 by the time you're done 20 years later, you'd be pretty proud of that. But this investment, leaving $26,000 in that investment by keeping it, or in other words, not taking it with you when you sell for the down payment on the next one, that turns into, in the same amount of time, an investment that's worth $1.6 million to you between the equity and the cash you put in your pocket.
That's
That's
so huge.
substantial. Yeah.
Yeah,
So,
and if we want to get into the numbers on that, I mean, it gets even crazier. And we'll talk about how it's not just all pie in the sky, easy to do always, because there are costs to being a landlord, and there's skills that you have to develop or pay for in order to execute on this. But still, just look at those numbers and tell me if it's worth it. What do we have for annualized return there? We have year one, the first year, is 285% rate of return. Do you want to explain why that's so high?
It's so high in the first year because you didn't give up those concessions, right? You left $26,000 of cash. You sacrificed that to keep that first property. And by the end of the year one, you have $105,000 of equity, or almost $106,000 equity in that house, because you started with 65 to begin with that you wouldn't have had you sold it. So you started with 65. That property is a $650,000 property. If it appreciates by 4.5%, and you have a little debt pay down, then you've got $106,000 equity by the end of that first year. So even though you're negatively cash flowing, that sacrifice that you made of not taking 26,000 extra dollars to your new home has become $106,000 of equity in that last home. Now, because it's
That's an
negative cash
immediate
flow,
return. Yeah.
yeah, that's what makes that first year return so huge. Now, there is some negative cash flow. And again, this is when it's occupied and when there isn't an outlier expense. But this negative cash flow, this is the accumulated negative cash flow throughout the year. And that does include some vacancy, and it does include some maintenance expenses. So at the end of the year, you've got some negative cash flow there, but I'm subtracting that from your equity here to show you what the true value of your investment is. And it's still 100 grand. So you left 26, you sacrificed taking $26,000 more cash to that new house. And in exchange for that, you've got an investment valued at 100 grand a year later. And by year five, it's 271. So you got $288,000 in equity. You're cash flowing almost $400 a month. It's 387. Your accumulated cash, again, that's accounting for vacancy and maintenance. That's a negative number. Again, that's accumulated over 5 years. So that's not what happens in the fifth year. That's what's happened total over the 5 years. So I'm subtracting that cash from the equity. So your total investment value is still substantial. So you made a cash sacrifice of 26,000, and 5 years later, you have an investment value of $271,000. Now it's a lot lower of an annualized rate of return. It's about 60. It's funny to call that low, but it's a lot lower than 285 because that initial boost by not paying those sales commissions in the sale, that gets spread out over 5 years. So it's going to bring the annualized rate of return down. And by year 10, your investment is now worth $565,000 in equity. Your accumulated cash is about 6 grand. You're cash flowing by that time almost $1,200 a month. Your total investment value is 571. So 10 years later, you still got the house. You wanted to move anyways. You wanted to move into that bigger house or the house in the other neighborhood or whatever. You still have that, like you're living there. That's the life that you're living on a daily basis with your family. But here you have this investment property that you kept that's worth 571. And I hear echoing in my mind, and you've probably heard this 100 times and even thought it yourself, houses that we once owned and we think, I should have kept that. You look at the value of a house you used to live in, how many times
Oh, yeah.
everybody listening to this, unless you're living in the first house you bought, everybody listening to this, it has some idea of the value of the house that they used to own that they left. This is how this plays out. If you keep that, that's why it's so valuable. And we're in a unique environment where this is more possible than other periods in history, simply because you have that 2.75% mortgage or the 3% mortgage or that very low mortgage on the home that you're currently living in. That's what makes this possible without massive negative cash flow. This is only negatively cash flowing $144 a month. And if you're uncomfortable with that, by the way, if somebody's like, well, I really don't want to negatively cash flow at all, then just take a smaller HELOC. Leave 15% equity in that home. That means the HELOC will be smaller and your cash flow will be, in this case, let's see if we got it to positive. Yeah, it's $117 a month.
But
So,
I mean, on the other hand, your mortgage costs more on your new house. And so, I mean, we can do some math around that. Is it more expensive between paying all three mortgages, right? You have the old 2.75 mortgage, you have the new HELOC, and you have the new personal residence mortgage. So, I mean, that's where you need to bake in your cash flow, not just the investment property. Although that is useful to track your business and see how it's doing. It's probably a good idea to track all of your cash flow. And one thing I want to mention too, when you scroll over to the right where you've got those annualized rates of return, we kind of just glossed over those and they're just enormous. I mean, we
oh
talked
yeah.
about year one, 285%, year five, 59% rate of return. Where else are you going to get these? And by the way, I want to see this, but I'm kind of afraid of it. What if we did this as a short-term rental, which has greater income potential? You have higher costs like property management and such, but a well-managed short-term rental in the right market can be significantly higher in cash flow. So, I mean, I'm almost afraid to run those numbers, but they're going to be even bigger.
Yeah, and of course there's all sorts of stipulations with that. You might not be in a home where a short-term rental is even possible.
Of
So
course.
I always think like if you're living in a lot of times people think short-term rentals need to be in a mountain town like Steamboat Springs, Colorado or Park City or something. But short-term rentals are very popular even in just suburban areas for people coming in for weddings and funerals and to meet up with family from different places in the country. Like I have clients and friends who have short-term rentals in places that you would never go as a vacation, but you have people coming in for, they're helping a company install some software and they're going to be there for 5 weeks or something like that. Then they're booked out all the time. It's really common for people traveling around the country on road trips or whatever to stay in Airbnbs that are in just regular metropolitan areas. So if you can swing that, if the home you're living in would work as a short-term rental, that is definitely an option, and those generally cash flow better.
Yeah, and we're there's so many variables we're not keeping track of. Like you're also gaining probably a greater percentage of wealth on your new home on a dollar amount basis because $1 million home or a $900,000 home, even if you maintain appreciation, which we don't know, it just kind of depends on a lot of market factors. The amount that a $900,000 home appreciates is possibly more than a $500,000 home appreciates by a
Yeah, if
straight
they're in a
dollar amount.
similar
So your wealth is
market.
increasing.
Exactly. If they're in a similar market and that market pushes values up 5%, that's a bigger dollar value on your $900,000 property than your $600,000 property. So either way, like the reason I thought of this and the reason I think this is helpful is I think there's a lot of people in the country that live in a home that they would like to move from. It's not a bad home, but their family's growing or their whatever the stage of life that they're in just makes that neighborhood not as desirable for them as it was when they bought it. And they can afford to go into that house that they want, but they're not doing it because they want to keep that 2.75% mortgage. And this is a way to let that 2.75% mortgage work for you and go to the house that you want without feeling like you're letting go of something precious, that very low interest rate mortgage.
Right. We should mention the cost too of being a landlord. It's not for everybody. You can hire that out. That might be a whole different discussion. Maybe we bring a property manager here as a guest to talk about that. Because it's not just. I mean, a lot of people call real estate investing mailbox money. I don't think that's quite true. I think it's more like, and I know you do too. It's more like running a business. You have customers who are your renters, and you have business expenses, and you have to, you treat your customers like humans, and all the
Yeah.
messes that could potentially come with that. So
It's a small business. It's a relatively simple small business, but it's a small business. I completely agree with that. Good point. Um, One thing we haven't talked about, by the way, is the tax benefits of doing this. This
yeah, I was
is
going to talk
just the
about
rate of
that.
return before any tax consequences.
Right. So go over to the tax field over there, if you would, please. And
The
scroll on
tax
over.
field. Oh, the variable.
Yeah, on the left. Yep, the
Yep.
variable.
Here we go.
So we have in there 0% or yeah, down there, marginal income tax rate, because that is a very real cash flow benefit when you have that in there. Now there's stipulations to that because it's much more powerful, or if you are real estate professional status, then you get to take losses against your active income. But even so, you can carry over the losses on a rental property indefinitely. And so once that property has pretty big cash flow gains, they will be offset by past tax losses. And so that's very real. We have it in zero. We have it in a zero again here because we want to show a very conservative way. We're trying to stack the deck in favor of, not doing that. And so we have this marginal tax rate at zero. What happens if you put, I don't know, 24% in there?
24. So that's not going to change your cash flow from the property. So this graph doesn't change, but the others change dramatically. So immediately you're cash flowing positive from a net standpoint right out of the gate. It's pretty small because I consider tax benefits a cash flow benefit because again, there's
Right.
two forms of wealth in real estate. There's the cash and there's the equity, and the tax benefits belong in the cash bucket. So they show up in the cash bucket here. Now let's scroll over to the rates of return. Remember, it was 285 in the first year. Now it's 332. And your accumulated cash is a positive thing, even though you're negatively cash flowing slightly on the property. Between the tax benefits that offset more than that cost, you're still in a cash flow positive situation at the end of the year because of the tax benefits.
Well, it's it's rarely factored into the equation because it's asynchronous. Your tax benefits come often when you file your return. So
Yeah,
it's
and
not,
everybody,
whereas your monthly cash flow comes in every month, where yeah, the tax benefits, I mean, you keep more on a year to year or a month to month basis, I suppose, but it's really accentuated on like April 15th, for example. So
exactly. And everybody's tax situation is so different because if you're in the 24% bracket, a deduction, a $100 expense that's a business, if I can qualify it as a business expense versus a personal expense, that saves me $24. But if I'm in the 12% bracket, it only saves me 12. So tax benefits affect everybody a little bit differently. But so I like to run them with 0% and then put an example in there to show here's what this is likely to help you with from a tax perspective, just so you can see the comparative difference. So, and it turned, remember the 5-year number was about 59 and now it's 67. And these are annualized returns again. So it's not that you got 67 in that year. It's that 26 turning into 339 in 5 years is a 67% annualized return. Now, this is something also, it's important to know, this isn't something that can scale. You can only do this on a certain amount of money because you're in a situation where you live in a home that you have a great mortgage on and you can afford to move into that other home and you want to do that. This is the only amount of money we can get these returns on. I wish I could tell people how to get a 67% annualized rate of return over the next 5 years with unlimited amounts of money, and it just doesn't work that way. We're just talking about this sacrifice that you make to keep the home, I feel like I'm repeating myself many times, but because this is the bottom line. This is the cash sacrifice that you're making now. That's how much less you're taking to buy the new home with. But here's what that turns into in dollar value for keeping that home based on certain assumptions that we showed earlier, like a 4.5% appreciation and so on.
I wanted to add a note here that it becomes tricky to do this depending on what kind of loan you have, but most will allow you to do this. The only one that makes it kind of weird is an FHA loan. Now, for an FHA loan, you have to move. I mean, there's pretty weird circumstances there. The biggest one is you have to move at least 100 miles away. It's kind of tricky. So ask your loan officer about how to keep your FHA mortgage and get another one if that's what you're after. VA loans, you can do this too. Conventional, you can certainly do this. Bank statement loans, most people don't hold those for very long, but there are some thorns in the process there, depending on what kind of loan you have, but they're sparse. So this is very possible for a lot of people out there.
Yeah, it's a really common and available thing for them. So that's what we geeked out about over the past week. Kind of fun stuff.
Yeah, and next week we're going to talk about something pretty cool too on what it actually costs you if you're waiting to buy, if you're waiting for your interest rate to go down by 1%, an entire percent, and that happens over 1 year. We got some good stuff coming to you next week as well. Anyway, thanks for tuning in. We will talk to you soon.
All right, thanks, Dan.